Timing the market is generally a fool's errand over the long term. We've seen that proven time and time again with investors, experienced and inexperienced alike, failing to beat, or often even match, their benchmark indexes over the long haul. However, that doesn't mean that there aren't some indicators that have historically signaled that there was going to be some short-term turbulence ahead. Today we're going to be discussing probably the most well-known of those signals, the yield curve. Because at least throughout recent history, when the yield curve has inverted, it has been seen as a sign that a recession, and likely a stock market crash, was on the horizon. The yield curve inverts when the returns of short-term treasuries, such as the 3-month treasury, become higher than the longer-term treasuries, such as a 10-year treasury. In this video, we'll be looking at the history of economic recessions, stock market crashes, and the yield curve to see whether its oracle-like reputation of predicting hard times is well-founded, and if it is, what, if anything, we as investors can do about it to make the most of our investments. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So according to the National Bureau of Economic Research, there have been 9 official recessions since the start of the 1960s. The first began in April 1960 and lasted until February 1961. Many believe the recession was brought on in large part because the Federal Reserve had begun raising interest rates in 1959. When the economy emerged from this 10-month recession, it began the second longest period of growth in NBER history. The second recession came near the end of the decade, beginning in December 1969 and ending in November 1970. However, despite its slightly longer duration, it was generally considered milder than the previous downturn, with peak unemployment only rising to 6.1%, and the peak-to-trough GDP decline only clocking in at around 0.6%, compared to 7.1% and 1.6% for the recession of the early 1960s. The third recession was the 1973 oil crisis, which began in November of that year and lasted until March 1975, making it the first recession since the 1930s to last over a year. Combine this with the fact that inflation and unemployment were relatively high and wages were not keeping pace, and it was not a fun time financially. The fourth recession lasted a mere 6 months, beginning in January 1980 and finishing that summer in July. However, its peak unemployment and peak-to-trough GDP drop figures of 7.8% and 2.2% respectively place it behind only the oil crisis among the recessions mentioned so far on this list. And unfortunately, the recovery didn't last long, for the fifth recession began a year later, in July of 1981. The economy didn't recover from that recession until November 1982, which ties it with the oil crisis of 1973 as, to that point, the longest recession since the Great Depression. However, given that unemployment figures remained fairly high in between the 1980 recession and this one, and you could make a fair argument that this might have been even tougher to weather for many people as they saw that W-shaped recovery take place. The sixth recession took place from July 1990 to March 1991. Compared to its contemporaries, it was a fairly mild one, with the peak unemployment and peak-to-trough GDP declines being less severe than any of the recessions we've seen in the 1970s and 1980s. What's more is that it was followed by the longest bull market in history at that point in time. The seventh recession didn't get started officially until March 2001. And despite everything that had happened in the stock market during that time, which we'll get into later, economically speaking, this recession was relatively brief and relatively shallow. It ended in November 2001 after just 8 months, which places it in a 4-way tie with the recessions of 1945, 58, and 90 as the second shortest recession since the Great Depression, trailing only the first recession of 1980. During that same time frame, its peak unemployment of 6.3% was the third lowest on record, and its GDP decline of a mere 0.3% was the lowest. So all things considered, it wasn't too bad as far as recessions go anyway. The eighth recession was the Great Recession, which was quite a bit worse economically. It began in December 2007 and lasted until June 2009, making it the longest recession since the Great Depression. And its peak unemployment and peak-to-trough GDP declines of roughly 10 and 5% respectively both rank fourth worst since the Great Depression. The ninth and final recession during this period is the 2020 recession that, at least as of this recording, we're still in the midst of. so we don't have official figures for it yet beyond the fact that it officially began in February. The history of the stock market is, as you would imagine, a bit more volatile than that of the broader economy. And while there are certainly similarities and correlations between the economy and the markets most of the time, it's important to remember that they aren't the same thing. To illustrate that point, the stock market, as measured by the S&P 500 anyway, has experienced crashes of at least 20% from previous highs without the aid of a recession on at least 3 separate occasions since 1962. Those were in 1962 to 1963, 1966 to 1967, and 1987 to 1989. There was also an instance where the market dropped to a bottom without the aid of a recession officially, even though one did eventually come along before a new all-time high in the market was set, such as the downturn from 1968 to 1972. On your screen now, you'll see every instance of the price of the S&P 500 falling by at least 20% from a previous peak. We have the date that the old high was set, the date when the price of the index bottomed out, and how far it fell, the date that the new high was set, and approximately how many months it took to go through that whole process. You'll notice that since 1980, the major initial downward movements of the market have mostly coincided closer to the performance of the economy as a whole, even if the duration of the market's process to recover isn't always the same as the wider economies. Case in point, the crash of the 1970s. The market began dropping in November 1973, just as the recession was getting started. But while the economy recovered in 1975, the market didn't until 1980. Shortly after that, the economy experienced that pair of recessions in the early 1980s, while the market didn't recover fast enough to experience a second crash in that time frame. The other outlier is, of course, the flash crash of 1987, which was not accompanied by a recession officially, despite being just as severe as those other falls of the early 1980s for the markets. But with that out of the way, let's get into the meat of this video. How well does the yield curve do in predicting economic recessions and market crashes? Since the mid-1960s, the yield curve has been inverted surprisingly often. All told, it's been inverted about 7 to 8% of the time, or roughly every 2 weeks on average, but that's obviously because it often stays inverted for a little while and not because it actually inverts that frequently. With that being said, in the interests of time, and to make the investing portion of this video later a whole lot easier, I'll only be referencing monthly data in this video, and beyond that, only the first month for each time the yield curve inverts. So for instance, in this video we'll be using the 3-month Treasury as our short-term yield indicator, and the 10-year Treasury as the long-term indicator. And in the dataset I have available to me at the time of this recording, I have yields for the 10-year Treasury going back to 1962, so that's as far back as I'll be looking. The first time that the yield on the 3-month Treasury eclipsed that of the 10-year Treasury was January 12, 1966. So I would say that in January 1966, the yield curve inverted. However, in that particular case, by January 14th, the yield curve had returned back to normal, with the 10-year Treasury having a higher yield than the 3-month Treasury. So for the sake of the example for this video, I would say that by February 1966, the curve had normalized, because again, I'm only referencing monthly dates. The second time it inverted was in September 1966, and for the most part, it remained inverted until March 1967. There may have been some days here and there during that time where it normalized quickly before inverting again, but since most of us receive our paychecks once or twice a month and we're not day trading here, it probably wouldn't have had too much of an effect on our investment decisions, even if we were investing based off the yield curve like we will be in our hypothetical example later in this video. So we're just going to assume that it remained inverted during that time. I hope that makes sense. But with that said, the yield curve has inverted 16 times since 1966 based on those assumptions. On your screen now, you'll see the month of the initial inversion and the month of normalization for each of those instances. That's quite a bit more than the number of recessions we've experienced during that time, or even the number of market crashes we've gone through. So how accurate is the yield curve as an indicator of an oncoming recession? Well, first things first. The recession of the 1960s doesn't count because I don't currently have data in front of me going back that far for the 10-year Treasury. So even if the yield curve did invert beforehand, I wouldn't be able to show it in this video. Out of the 8 other recessions, the yield curve has been inverted at the start of 5 of them. So in other words, its odds of predicting an oncoming recession in this admittedly very tiny and not at all statistically significant sample size was hardly better than a coin flip. Let's look at each of the instances individually. It correctly predicted the recession of 1969 by inverting in July of that year. In 1973, it inverted in June, foreshadowing the recession that would begin 5 months later. In 1978, it was again accurate, inverting in December just over a year before the first recession of the 1980s. It improved its winning streak to 4 straight by inverting in October 1980 before the next recession would begin in July 1981. However, after that, it would not successfully predict a recession again until this most recent one here in 2020. Sure, it did invert in June 1989, but it had normalized by August of that year. Thus, everything from the yield curve's perspective looked normal in July 1990 when the recession actually began. The same could be said about the dot-com crash and Great Recession, though they were at least closer to being successfully predicted than the 1990 recession. However, I don't personally choose to count those as successful predictions because, at least as an investor, I'm not sure what to do with the information in those instances. If I did count those as successful predictions, I'd probably also have to look at the instances where the yield curve inverted and no recession followed as failures, such as the inversions of 1966 we discussed a minute ago. Whichever way you choose to look at it, as far as I can tell, the yield curve is not exactly a guarantee of an oncoming recession, even if a fair few of them have followed it in the past. To me, this means that whenever the yield curve should invert in the future, I don't need to necessarily change my investing behaviors per se, but I might want to beef up my emergency fund and other savings a bit just to ensure that I'm alright should the storm arrive. As far as predicting market crashes goes, the yield curve's success remains more or less the same, as do the caveats. First, the data shows that the yield curve is not always accurate. You'll notice that it completely missed the flash crash in 1987, for instance. And second, it isn't always perfectly timed. For instance, it inverted in September 1998, well over a year before the start of the dot-com crash, before normalizing again in October. It wouldn't invert again until August 2000, a handful of months after the crash had already begun. If you were trying to time the market by following the yield curve, you would have either mistimed the market late in 2000 or executed a false sale in 1998 and potentially saddled yourself with a hefty amount of unwanted capital gains and the taxes that sometimes come with that. And third, as I said before, it's an extremely small sample size, it really is. We're dealing with 8 recessions and crashes here. Even if the yield curve had managed to successfully predict them all, that wouldn't necessarily mean that it would be able to continue to do so moving forward, though it certainly would do a lot to help its case going forward. But with that being said, based on this, again, very small sample size, could someone have beaten the market by selling out every time the yield curve inverted? As it turns out, the answer is a very solid maybe. Hypothetically, if Jane had invested $500 a month into the S&P 500 from 1962 until June 2020, which is the most recent completed month I have available to me at the time of this recording, she would have ended up with a net worth of a little under $20 million. That's an average return of about 10.4% per year, assuming dividends were reinvested. If Jane had instead invested normally until the yield curve inverted and then sold all her shares and held cash only to buy back into the market when the curve normalized again, she would have ended up with a net worth of around $34 million. That's an average return of around 11.6% per year, which is noticeably better than the first scenario, but there are a few things to keep in mind here, beyond the caveats we already discussed. The first and probably biggest one is taxes, and any other potential expenses she may have from the more frequent trades. Because unless Jane had all this money stashed away in various tax-advantaged accounts, which she very well may have, she would be on the hook for a lot of taxes. And it wouldn't always be the more favorable long-term capital gains taxes either, because there were several instances where the curve inverted within a year of the previous sale. So Jane may have been on the hook for additional ordinary income taxes as well. And when we're talking about potentially 6 or even 7-figure gains in some of these instances, not to mention the fact that the tax rates were actually quite a bit higher in some prior years, such as much of the 1980s, that could be a pretty tough situation to deal with for Jane. And it could have a huge impact on her eventual ending net worth, which is not reflected here. So in other words, take that $34 million figure with a grain of salt. The other big one is the limits of this hypothetical. We're obviously only capturing a small piece of our economic and financial history today. There's every chance that if we were able to expand our view back to the rest of the 20th century, and even before that to the 1700s and 1800s, we might see a very different picture. The same goes for looking at other investments in markets beyond just the standard S&P 500 index fund that we use today. So in summation, does the yield curve predict recessions or crashes? Well, sometimes, but it is by no means foolproof. And while it is an important indicator to keep an eye on as investors, we might be even better off if we broadened our view to take in all the other signals that are out there. And as always, the most important thing to do in order to prepare for a recession, market crash, or some other emergency is to have a plan in place before it happens. Or, if it's already happened, to get a plan in motion that'll help us get our financial houses in order as soon as possible. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.